one of those things that you just dread when the life insurance agent wants to talk to you. And so it's important because most people just shut off. They think, well, maybe I need it, maybe I don't. I always say life insurance is not usually purchased, it's usually sold. And most people that have life insurance is because an agent convinced them to buy the insurance, normally out of fear. Sometimes people will request it, but most of the time that they do, it's because they have term insurance. So let's just cover some of the basics. We're not going to spend a lot of time on this, but I think if you understand really what the life insurance, the different types of life insurance, and how they are used, then it will help you understand what these defensive moves are and even offensive moves that you can make under the virus, under this situation that we're under, okay? So first, term insurance, and we're going to cover variable life insurance. We're going to cover solvency of insurance companies, payment delays, and not having a hybrid life insurance policy for long-term care insurance. We're also going to cover offensive things that you can do with the cash flow in the current environment, maybe some opportunities. So let's start and just kind of give you an understanding of what is life insurance, term insurance. So term insurance is the purest form of death benefit. And how is it configured? Every company will figure out what their actuaries estimate to be the number of deaths based upon certain ages, based upon certain health ratings. Then what they do is they mark up what they have to cover. They figure out what their expenses are. They figure out what their taxes will be. And then they figure out a profit margin. So a lot of times people will say, well, why are some term insurances so different than other companies? Well, if I go back a few years, when General Electric had their executives flying 747s across the country to play golf games, if that was your insurer at that point, you are paying for that 747 with an increased premium. So again, a lot of it has to do with the insurance company, where they're located, the state you're in, state premium taxes. So this state has a very high state premium tax versus, say, buying it in a different state, which either has little to none. South Dakota, Wyoming have very small premium taxes. That's a tax that the state assesses to each insurance premium dollar that's paid. That's how the Department of Insurance survives. Good to be a government, right? That's how you generate your revenues, is by taxes. So a term insurance only covers you for a period of time. I mean, at the end of that period of time, and this could even be a group policy that you have. So I want you to really listen to this, because you might have retired. You might have had a group policy that you can actually convert, you can use just like this term insurance. So this isn't just something that you're buying. When a term insurance expires, you got a couple options. One is you can renew it, but in most cases, that can cost you up to 1,000% more. A lot of times people say, well, I don't understand why. Because the insurance company wants you out. They have collected their premiums. They've not paid any claims. It's been a great deal for them. If they're going to assume the risk, and they know that if you are renewing that you might have a lot of high health risks that they don't want to, for the same price, renew you. They'd rather have you go through the entire process again of proving your health. That's one option, is you can renew it, but it could be very expensive. Now, if you do have health conditions, this might be one of your options. You can just let it expire. It becomes like car insurance, right? Car insurance, you pay. If you don't get in a car accident, hopefully you don't, then whatever money you've paid, that's the cost to insure that automobile. Certain policies, especially term insurance, now this is really important under this virus, because I'm going to show you how and what is happening with the chronic illness that is continuing after people, if they live through this horrible event, they are retaining some lung scarring. And I want to show you why this makes a difference if you have a conversion option on your term insurance policy. So certain policies allow you to convert. What converting means is if I have $1 million term insurance and it ran for 20 years, my 20 years are up. I have a choice of just letting it expire, not paying for it. I have a choice of renewing it with the company, but then I'm subjected to whatever premiums that they might pay. Or third, what I can do is I might be able to. Now, I'm not telling you that this is something that every company is going to offer. You have to read the contract. You can convert. Now, if you convert, you have to look at what the policy terms are. Sometimes they'll let you convert into a whole life, sometimes into a universal equity index life, and sometimes into a variable life. It just depends upon the company. So again, when you have a term insurance, you have an expiration date on that. You have conversion options. Sometimes you have no options, and if you're unhealthy, then this is a problem. This is where we're going to talk about this issue. We now know that if you survive, if you've gotten the COVID-19 and you survive, about 80% of people are going to have some type of lung scarring or damage. Now, when you read some of these statistics, we don't have the kind of numbers that we should have now, and we don't know to what extent that damage is. However, what we can foresee is that if you have had it before, it may become one of those questions on a life insurance policy application. Like now, they ask you, I don't know, do you skydive? Do you have, there's like a million questions. I don't even know those questions, but there's about a million questions about any kind of medical thing that you've ever had in your life. And if you answered yes, there's the potential now that you could either be declined or rated if you've ever had COVID-19, because we're not 100% sure of what the ongoing illness or what some of the ongoing dangers might be and the reoccurrences. So it is a danger. So this is why we're talking about this today, to make sure that if you have life insurance and some of those term policies are expiring and you do come down with this virus, that you're going to make some smart and some wise choices. So we do know that you can continue the premium under certain circumstances. And also, if you become disabled, you may not be able to get term insurance. And the biggest problem that I see with term insurance is there's no continuing care for long-term care. And we're going to talk about that in a second, because that might be one of the ongoing, unforeseen issues that we have right now. We know that certain people that have had certain diseases that affect their kidneys, their liver, these are things that, they're chronic and they're ongoing. Here's a great example. My dad had cirrhosis of the liver. Guy never drank. And so in talking to the healthcare professionals, we found out that this could be from an illness, from an operation, from an infection. And these are things that could affect you that we don't see, and they're not necessarily related to what we think that they might be related to. So let's talk about variable life for a second, because I can't tell you how many times I tell people do not buy variable life. This is an absolute, I'm not very critical of certain things, because I really believe in the financial world, you are presented with tools. These tools are generally not good or bad because they're used for a specific purpose. Like if somebody said, is an annuity good or bad? Well, if we're talking about a fixed or an equity index annuity, I would say it's neither good nor bad. It's how you use it. But if you ask me about variable annuities or variable life, I will do everything that I can to convince you to never do these things. These are things that are sold by high commissioned agents. There's huge ongoing fees. And just in my history, I've never seen them work out. I'll give you a little history about what I see. History repeats itself. So most of you know that I've been doing this for 3.5 decades. And when the tech boom hit, that's when variable life became a big, big hit. These people were selling variable life and they were showing returns on their proposals of 10 and 12 and 14%. And I would try to convince people these are not sustainable returns. And, of course, the agents have these fancy illustrations. They come back and they'll say, yeah, but look at the track history of this. On average, it's done this. I said, okay, but in the down times, in those 5 to 7 years, maybe where it hasn't done that, it's gone negative. Are you modeling that out? No, we're just using an average rate of return. Well, that sounds pretty in an illustration, but it's not reality. So let me show you why I am so against variable life. Now, in the 90s, when the tech market crashed, there were a lot of people that were sold variable lives because during the tech boom of 96 and on, people were buying and selling investments in the tech market and they were getting clobbered with income tax. So the insurance agents sold these products to people with the sales pitch that, hey, you can trade your mutual funds from one to another without having to pay tax. When I really started ripping these things apart, I said, but this isn't reality, because these variable lives are based upon the concept of matching a term policy and a mutual fund. So the insurance company wraps it together, and what ends up happening is the mutual fund has an intended increase in the rate of return. So we're assuming that it's going to go up by a certain rate of return, and the increasing premium on the term insurance, and I'll tell you what we're going to do here. Hopefully this will go through. So the increasing premium on the term insurance is going up. So as you are getting older, the goal of the mutual fund is it's supposed to go up. But we all know how the brokerage world purports things. You know, you'll say, well, how is this perform? Well, over the last 30 years, it's done 8% rate of return. And I use this as the example. You cannot use a static or a lineal 8% rate of return. And I can't explain anybody that's said it better than the late Zig Ziglar. Zig Ziglar was a public speaker, but I always remember that he said something about averages. If you put your left foot into a bucket of hot boiling water and you put your right foot into a bucket of ice water, on average, you should feel comfortable. However, that's not how it works, and that's not how the stock market works. All of a sudden, you have 10 years of a bull market, and then within 3 weeks, you show a 30% loss, and then within 1 week, you've gained back about 12 to 14% of it. Doesn't work like that. So when you start trying to combine investments that are volatile and fluctuate like they do in the stock market, but you have a fixed term insurance payment, because remember, a variable life combines these two together. And one of the statements I've coined is, don't try to pay a fixed expense with a variable investment. And if that statement doesn't hold true with variable life, I don't know what it holds true with, because variable life, you're trying to pay a fixed expense of the term insurance with a mutual fund that fluctuates. So as long as that mutual fund goes up every single year, it can meet the obligations of the increasing premium of the term insurance. Because remember, term insurance is going to increase as you get older every year. But what happens if you have a down market? Well, then the mutual fund is not performing enough to keep up with the increases in the premiums. So what ends up happening? You have to make up the difference in an increase in premium. And what do I mean by that? Well, if you go back to the 1999 crash in the tech market, all of a sudden, these people that I was telling, they would come into me and I'd say, listen, you just do not buy this variable life, or if you're in variable life, get the heck out of it. And some of them said, no, I don't want to do that. I have a great product. The market's going up 20% per year. And then the market crashes. And then the NASDAQ goes down 75%. And then the big surprise happens. They get this premium notice in the mail, and it says, well, your premiums were $10,000 a year, and now they're $25,000 a year. And surprise, surprise. And all of a sudden, now, in order to keep this policy, you have got to increase those premiums. So what do? Well, you have to increase the premiums. And if you don't, what ends up actually happening? Well, the policy can actually foreclose upon itself, and it can cause a taxable issue. The reason is, let's say that you put in $100,000 in premiums, but now your policy is worth $120,000. And let's say now that what happens is that the premium increases because it was maybe worth $180,000, but the market dumped and now you got $120,000. Insurance company sends you a premium notice increase. And you say, the heck with this. I want to get out of this thing. So you cash it out. Well, whatever that gain above the premium is becomes taxable income to you in that given year. And you're going to see this in a little bit as we go through today's presentation. You've also been sold, many people have been sold by insurance agents on the idea that you can make a life insurance into a retirement plan. It is not now. It never has been. And it will never be a retirement plan. Why? because if you start to borrow money, now I'll make a clarification. If you have a plan, like a pension plan, and you buy life insurance in that pension plan, you're already getting a 20 to 30% discount on the premiums. And what I'm about to explain to you does not apply if you buy life insurance inside of a pension plan. Most of you have not. So this discussion really applies to most of you. If I have a life insurance policy, and let's say I was sold on the idea of this variable life being this great retirement plan. If it's a great retirement plan, I put in, say, $100,000 in premiums. And now let's say I have $200,000 in cash value. Now, many agents will show that you can take a supposed lifetime tax-free income from this as a retirement plan. Well, the problem with that is that you have to die in order for that life insurance loan to be paid back. If during that period of time where you are taking money from that life insurance in the form of a loan, if the cash value goes down because of a market crash, you have two choices: increase your premium or cash the policy out. If you don't allow the death benefit to pay off the loan that you're taking to live on this supposed tax-free retirement income, you will incur a tax on all of the income, on all the gain as ordinary income. You don't even get capital gains tax treatment. Now, you know what's interesting is, because I've been doing this so long, I've seen this so many different times. The insurance industry, every 10 to 15 years has a changing of the guard. That means that lawsuits and class action suits might encumber one CEO and that management team. Then as they retire, another team comes in. 5-6 years later, they come up with these sales strategies. Then all of a sudden, major things happen. These things blow up on people. The management teams get sued in class action lawsuits. And then the cycle just repeats itself. So I'll give you a little walk down memory lane here. So back in the early 80s, when I started, there was this new kind of life insurance that came out that was called Universal Life. And the agents were out promoting this and showing 10 and 12%, in some cases 14% rate of return. Why? In the early 80s, you could go buy a CD and it was making 18%. But when people bought it, the Universal Life, they never made the question, they never asked the question, well, what happens if I don't earn that kind of rate of return? Well, what happened? As time went on, those rates of returns got under control. Remember, that was back in the Jimmy Carter years with hyperinflation. And soon, not too far after that, when Reagan got in, then all of a sudden it started to pull back a little bit. And what ended up happening was the inflation came down, interest rates came down, and all these people that had these universal lives, it blew up. Major class action lawsuits, because these were all sold as retirement plans. Now, technically, it's illegal for any insurance agent to propose, purport, whatever it is, a life insurance policy as a retirement plan. It's not a retirement plan, but they do. They still call them, these are retirement savings, and they come up with all these, what's this one thing that we saw in Texas, a LIRP, a life insurance retirement plan. I can't wait until these guys all get, their licenses pulled, because every 10 years this happens. So what then happened is, after all the universal lives kind of went away and new insurance regulations came out, here we go with the tech phase. Now the tech comes out, the tech boom of the mid to late 90s, right? And all of a sudden, what was the big giant craze? It was variable life. And every one of these insurance agents were out there going, hey, you can have a retirement plan. You can put money into mutual funds. You don't pay any tax on it. And then the tax market crashed. And then what happened? The things blew up, right? And so class action lawsuits, there was a giant lawsuit in Florida where MetLife really got stung, because they were actually going to the nurses' unions in Tampa, selling them life insurance as a part of their supposed retirement plan, class action lawsuits. There was another giant lawsuit in CalPERS, which is the California Pension Plan, where California was actually getting kickbacks by the insurance agents that were selling these products to the people in CalPERS, calling them a retirement plan. They're not a retirement plan. So now we have another phase. We have this variable life, and we also have what's called index universal life. Again, you buy life insurance for what it's intended to do, right? If I buy a pickup truck because I need to put something in the back. If I have a family of 5, I'm not going to go buy a 2-seater sports car. I got to buy something that will be conducive to meet my needs. Life insurance is not there as an investment vehicle. It's there as a protection vehicle. So let me show you what happens with the variable life as time goes on. There's also a problem with variable life because most variable lives today do not have what's called a hybrid option. And there's much confusion that I find over the differences between a terminal illness protection and chronic illness protection. So what is chronic illness versus terminal illness? Because sometimes people come back to my planners and my planners relay to me what the public is telling them when they come in to do these discovery meetings and insurance analysis. And they'll say, well, the client thought that, if they went into a nursing home, they would have coverage. They only had a terminal illness waiver. What that does is it allows you to use the death benefit if you are deemed to be terminal within 12 months, you're going to die within 12 months. That is not there's such a small percentage of people that actually have terminal illness and can use their policy under those conditions. A majority of people have what's called chronic illness, which is long-term care. We now know, just history-wise, when I first started, there was only about 30% of people. So about 3 out of 10 people would go into a nursing home. Today, those numbers are 7 out of 10 people will go in a nursing home. And so we know today that that is one of our largest financial risks. And so you really have to know if your life insurance has a terminal illness waiver versus a chronic illness waiver, because a chronic illness waiver allows you to use the death benefit for long-term care. And depending upon the type of policy, it could provide in-home care or even in-facility care. So what happens if you can't make the premiums with a variable life? Again, it forecloses. And this is why I tell people, listen, do not believe everything that you see on these insurance company illustrations where they show you taking out these massive amounts over time, because these loans that they're proposing that you take out, those all have to be paid back. And if you have a market crash, you may not be able to pay them back. So let's talk about the next issue, which is insurance company solvency. Is your insurance company solvent? Well, the typical sales pitch that I hear is this. Well, my insurance company, this is the insurance agents telling people this. Well, this company, they've been around for 100 and some years. And, they've never, ever missed a single payment. And here's a question I have for you. How many of the Dow Jones companies that were originally in the Dow Jones Index have survived? How many of them are actually still in business? Do you know the question, or do you know the answer to that? Well, the actual answer is there's only one company that's still around that was in the original Dow Jones Industrial Average, and that is General Electric. All of the other companies have gone out of business. So we have, here's the other thing we always hear. We've never missed a payment. I've also heard that from Enron and MCI Telecommunications. So we don't really believe anything other than the balance sheets and what the states will actually cover in the form of a receivership. And what I mean by that is, if we look at Penn Treaty, we look at, there's company after company after company as time has gone on that has gone out of business. And the question is, how much in coverage do you have with that particular insurance company? So let's show you that. And it's called the State Guaranteed Fund. And you have to make sure that you don't have more, or you don't have too much insurance where it is not covered by the actual insurance company. So we're going to talk about really what is covered. If you are watching me in Nevada, I see some people here, and I actually know some of these names here that are on the list that are definitely not in Nevada. You'll have to check what your specific state covers. But if you are in Nevada, then you will see that Nevada covers for life insurance, if the company goes out of business, $300,000 in death benefit. So if you didn't pay the money out until June 1st, they were supposed to, but in the meantime, they went out of business. Now, does this happen? Happened to a lot of insurance companies, not in the life insurance area, but look at what happened back in the hurricanes. So I was living in Florida for about 14 years. And when Hurricane Andrew came through, a lot of those insurance companies ran out of money because there were so many claims. The state had to step in, and the state only covered what was actually in the state guarantee reserve system. So again, you have to be very careful as to what the amount of insurance is that you are insured for. Now, there's also restrictions. So it depends on what state you actually buy that insurance in, and then what state that you continue to reside in. Because some states say that as long as you continually reside in that state, you will have coverage. Some states will say if you move to a different state, they'll still cover you. So you just have to make sure that you are being covered properly in the state that you live in. Now, it looks like I'm watching a screen here, and let me just do a double check because we know that we're having internet issues. Daniel, I'll just double check. Can you now see the Guaranteed Insurance, Nevada Guaranteed Association on your screen? If you can give me a hand raise. All right. So I'm not sure what the latency is. I know everybody's on the internet now, so we're having issues. I certainly know it's not just us. I've been watching multiple news stations throughout the day, and their people that they're interviewing are usually at home on Skype or whatever it is. And I was laughing today because half of the guests, you couldn't hear them. They bopped off because of the internet, all kinds of multiple issues. But this is just what we're faced with today. So hopefully you've got a little bit more time to see what's on the screen, to see, depends on what state you're in and what the limitations are within that specific state. So again, you got to be careful to make sure that you are under the limits. Now, sometimes if your insurance needs are much higher, what do? Buy multiple policies through multiple insurers or insurers, because you don't want a massive catastrophe to happen like what happened with Hurricane Andrew. We had people that at that time, I had an office in Bradenton, Florida, and we had people that were moving from Miami and Homestead in droves because there was nowhere to live. And I can tell you about two specific examples. One woman was a physician, and she had made it out of Cuba on a boat with her family, and she had decided that it was smart for her to pay off her home, have everything paid off, because in Cuba, you really couldn't own anything, and she just didn't feel like somebody coming in and taking her home from her. So her culture was to pay off her home. Well, she had a multi-million-dollar house, and that's where she put all of her savings to pay that house off. She lost the house in Hurricane Andrew, and unfortunately, the state guarantee only paid up $225,000. So she lost a majority of her life savings that she used to pay off that house. So when she came to Sarasota, or Bradenton, she was literally starting all over again. And the second example I have of this is we had another guy that came to Sarasota from Homestead, from Miami. And what's interesting, what I liked about what this guy did was he said, I don't want all my money in one place. So he did a reverse mortgage. He took it out. He bought some investments in CDs, whatever else he did with that money. When the hurricane came through, again, his insurance company did not cover because they went out of business. State comes in, gives a $250,000. However, what was good about that was a reverse mortgage has what's called negative equity insurance. And what that is that if your house is worth less by the time that it's closed or you die, in his case, it was disaster relief, then you do not owe the federal government back any difference. That's one of the benefits. So he was actually able to take a lot of his equity out. And unlike a forward mortgage, a regular mortgage, he didn't have anything to pay back. So there's two examples of where an insurance company was not able to cover their entire insured amount, but each person operated a little bit differently. One was devastated. One walked out of that thing no less further back than where he started. So again, it's important to know what your coverage is, especially when it comes to life insurance. And whoops, we lost one. Okay, so let's go back to payment delays. So one of the things that we learned in many of these catastrophes is that the insurance companies are delayed. They have delays. Everybody's in line. And so in the case of life insurance, it's a little bit different than, say, losing your car. I mean, you lose your car, you don't have transportation, but you might be able to take public transportation. You might be able to buddy up. When somebody passes away, the family has a lot of immediate cash needs, and those needs have to be met right then and right there. So one of the problems that we foresee is that with the potential of 100,000 people passing away due to this horrible virus, that there is going to be payment delays. It's just inevitable. So let's finish this up with talking about the lack of having a hybrid policy. So what is a hybrid policy? Well, a hybrid policy is going to allow you to utilize the death benefit while you are alive. And what I mean by that is, if we take a look at the concept of life insurance, it says we pay, and then when we die, they pay off. And it's inevitable. It's not like automobile insurance where you may or may not get in a car accident. Let's take a look at long-term care insurance. It's the same thing. You pay, and the numbers right now are that you have a 70% chance of going into a nursing home. Now, again, that's changed quite a bit since I started, but it was 30% back in the 80s, and now it's 70%. And that is attributable to we are living longer because of technology, but doesn't mean that we're living longer and mobile. It doesn't mean that we're living longer and we're still cognizant. There's Alzheimer's, there's dementia, there's a lot of horrible diseases that require that we have ongoing care in home and ongoing care in a facility. So back, 30 years ago, I never recommended long-term care insurance because at that point, the statistics were on our side. Today, it is a huge risk. It's probably a bigger risk than the short-term stock market risk because we know that if we believe in America, over time, this stock market is going to return in a big way. The economy will return in a big way. But we do also know that there's a 7 out of 10 chance that you're going to need up to $78,000 per year in long-term care. That's a pretty high risk. And the statistics in this case are not on our side. So we don't want people to go broke and they've got some giant life insurance policy, but during your chronic care, people are paying out all this money, and the healthy spouse that might be at home or the child that has to leave their job is going broke taking care of you. And then all of a sudden, 3 years, 4 years, 5 years later, all of a sudden, now they are going to get a life insurance policy death benefit. Might not do that. It might be a little bit too late. Now, some arguments have come out, and even people have brought this up to me, and they've said, well, the government says that the average person is only going to spend 3.3 years in a nursing home. Now, if you go back 30 years ago, even when there was only 3 out of 10 people that were going into a nursing home, and you asked why back then was there an average stay in a nursing home between 7 to 8 years? Here's what changed. When the government changed the policies on what Medicare would cover. So here's the example. This might be easier than explaining what the government rules are. Years ago, if you had a hip replacement, you would stay in a hospital for quite a long time until you recover. You might go home and have a physical therapist come to your house. What do they do now? You have a hip replacement and they send you to where? a rehab facility. But what a lot of people don't know is that when the government computes their statistics on the average stay in a nursing home, it's not technically a nursing home. It's including rehabilitation, because many nursing homes actually do rehabilitation. So let's say that you have a chronic illness, such as dementia. My grandparents were in nursing homes for 12 years. Well, 10 years, 10 and a half years. Grandfather died. About a year later, my grandmother died. But it was over 10 years, over a decade with that kind of illness. But if you now have a person that has a hip replacement and they're sitting inside of a facility for 2 or 3 years, do you understand how that skews the statistical numbers? It's not 3.3 years. I can tell you still, in talking to colleagues and other financial planners, we're still seeing an average of 5, 6, and 7 years in nursing homes. So do not believe the 3.3 years. So while you or one of your spouse is in a nursing home, or even needing in-home care, which is actually more expensive because of the costs and the modifications, whatever it might be, who's going broke? So the idea is that you do have a policy that will allow you to use the death benefit while you are alive. And again, that's called a hybrid policy. Now, these are rather new, and there's different types that are out there. But the key is, and here's how I think about the life insurance issue. We have this virus going on right now. Do we know what the long-term effects of this virus are? Do we know that it's not going to cause brain damage? Do we know that it's not going to cause chronic lung damage? Do we know anything about the organ damage that it may cause? Will this cause more people to go into nursing homes, need in-home care, need any kind of respirators? We don't know any of this right now. What I do know is, while a person is healthy, or if a person has a term conversion option, they should be looking at trying to make sure that the death benefit is accessible in a healthcare catastrophe. And why do I say that? Well, you can run out, you can buy long-term care insurance, and it is very, very expensive. It is somewhere between $3,000 to $5,000 per year, and sometimes per person if you got the right coverage. And the problem is, what if you don't go into a long-term care facility? What if you are one of those 3 out of the 10 and you don't use it, you die, the insurance company keeps all the premiums. Now, I don't know about you, but I'm not a favorite of banks, insurance companies, or brokerage companies. And maybe I just have this skeptical side, but I've always noticed, and maybe you've noticed this too, whenever you drive into a new town, a city, do you ever notice what the tallest buildings are in every single city? It's always the banks, the brokerage companies, and the insurance companies. And I don't know about you, I'm just not really one for building another floor on some insurance company because I didn't understand how they could get one up on me. And I like the idea of knowing, and this is what I've done with all my own insurances, I've converted them to hybrids. Look, I'm going to die. We're all going to die. It's a foregone conclusion. So we know that the insurance company is going to pay out that death benefit no matter what, unlike long-term care insurance, which may pay it out or they may not. It just depends on what side of the game you fall within the statistics. But now I know that I don't have to buy long-term care insurance. If I use it while I'm alive, great, it's there. If I don't use it while I'm alive for long-term care, I'm going to die. My family's going to recover the money. Maybe I just don't like the idea of thinking that an insurance company I'm going to pay all these premiums to for my life, and I'm just going to end up dying, and the long-term care insurance company is going to keep all my money or my family's money. I want my family to have a return on investment. Yes, I know you're laughing. Even after I die, I want them to have a great return on their money. So again, I think everybody should be focused on converting and making sure that they have hybrid on their life insurance, especially during this virus time, because again, we do not know what the long-term effect is going to look like from this virus. So let's talk about what the actions are that we can take right now to figure out if we should have life insurance or not. First, as you've always heard me say, I always lead with doing the calculations. First, determine if you actually need life insurance or not. How do you determine that? Well, it's also a combination of, do you need long-term care insurance or not? That's a calculation. Number two is, don't believe insurance agents that tell you to use life insurance as a retirement plan. Next, figure out what is the right kind of insurance that you actually need. Never use variable life. There are very few things that I will tell you never to do. One is privately sold REITs. Number two, variable annuities. Number three, gold. Number four, variable life. There are very few things, but those are a few of them I would tell you to stay away from. Universal index life, maybe. But again, you've got to be very careful on what the insurance agent is proposing to you. Look at those rates. Ask them to run the rates. Show me a 0% rate of return for a 2 to 3 year period of time. Then show me what happens. Whole life. Some whole lives allow you to have that hybrid option. Term insurance. Again, it's used for a specific need. In other words, I have a student loan, I die, I want to make sure my wife and kids aren't paying it back. I have a mortgage, I die, I want to make sure that my wife don't have to pay it back. I have an auto loan. But again, because term insurance has no equity, and if you are alive after the term insurance expires, it's not much different than auto insurance. You paid all that money and you get nothing back. If you own older policies, can you piggyback or replace for higher death benefit and or lesser costs? Now, what I mean by that is, we talked about under the annuities and under the beware of the annuities, is that over the years, they have changed the mortality tables. And I explained that when they increase life expectancy, it doesn't go well for annuity holders. But for life insurance holders, it's a great opportunity. So there were a few major times. One was 1956. I think the next one was 1982. The next one was 2001. And then we just had a change in 2017. This is where it's called the CSO, or Commissioner's Standard Ordinary. This is where all the actuaries from the insurance companies, they get together and they figure out what is the new life expectancy, right? And I think other than this virus going and just terrorizing the world, then our life expectancy was continuing to increase. As that happens, your cost of life insurance decreases because you're living longer, right? So there's more time to pay premiums, more time to put into the pot, less people dying that they have to pay out. So if you have a policy that was issued prior to 2017, and then again, 2001, I had people coming in that had literally bought policies in the mid 80s, and they were paying 30 to 40% more per thousand of insurance than if they bought it in 2005, even though they were 20, 30 years older. So again, you have to continue to evaluate what's happening within cost structures to make sure you can keep the cost down. Now there are great options. There are what's called no commission policies. This way, it cuts down a lot of the expenses and allows you to get a lot more bang for your buck because they're not paying out all those commissions. But again, it's not always available for all kinds of insurances. Check the solvency of your insurance company. Check your beneficiaries to ensure that a trust or trusts are listed as beneficiaries and not humans. I can't express how important this is. And again, even if you just have some little $1,000 policy, change it to the beneficiary to the trust. If you didn't attend any of my other webinars, I talked about probate being created just for $1,000 or $2,000, and make sure it all goes to the trust. What's interesting is I should have brought this out. This is so interesting. I have an insurance policy that my grandfather bought me when I was considered 0 years old. And so in the year of my birth, he bought an insurance policy. I can't cash it in. I can't even get a hold of the company because there's no records. I just have a certificate. The beneficiary is listed as him. He passed away. He was the owner of that policy. Or he was the original beneficiary. He was the original owner. He died in the 70s. I'm the insured. I have this certificate that sits and does nothing. I can't do it. So you got to make sure that these things are titled correctly. The beneficiary is correct. You have backup beneficiaries. You have backup owners. Otherwise, you're just handing that money. Somebody handed that money to that insurance company for, my grandfather died when I was 12, so whatever it was, he paid for that for 12 years. Insurance company never has and never will pay that money out. So you got to be careful. Check your beneficiaries. Make sure that they're correctly listed. Here's another option, is use a reverse mortgage on single life and back it up with life insurance. What is that? Well, this is an arbitrage strategy. It's no different than, let's say somebody comes to us and they're about ready to retire with a pension plan. And when you retire with a pension plan, they give you a couple options. You can take the most amount, which is called single life. But if you die, no one gets anything else. You can take joint life, but then you take a greatly reduced amount of income. And so what we do is this analysis when somebody retires and says, now look, you were going to go take joint life because if you died, you want to make sure that your spouse has enough income. Well, we explain to people that what the pension company is essentially doing is they're paying for life insurance, right? So let's say you had a pension plan and it was going to pay you $4,000 a month on single life. But if you said, hey, I want my spouse to get 50% of my pension, now they might only pay you $3,500 a month. And if you die first, then your spouse only gets half of the $3,500 or $1,750. So you're basically paying $500 a month to ensure your spouse gets $1,750 a month. So here's the question. This is one of the analysis that we do. Is could you take the $500 a month and self-insure? Could you go buy your own life insurance policy, spend the $500 a month, so you get the $4,000, you spend the $500 a month. And if you pass away first, your spouse gets the death benefit that if it's computed correctly, the spouse will get the same $1,750 per month. However, why I like that strategy is many people don't know that in a pension plan, if you choose survivorship option, what happens if your spouse passes away first? Well, there's nobody to insure. They don't pass it on to the kids. But now you're stuck down at $3,500 a month. So you're still paying for insurance for somebody that's never going to get any benefit. However, if you take single life option, you're getting $4,000 a month. And you're paying $500 a month for your insurance policy. If your spouse dies first, what do? Cancel the life insurance. You don't have the $500 a month anymore, but you're back to the $4,000. Again, it's always trying to figure out who is on the other side of that chess game, that chessboard. And in this case, it's the pension company and it's the insurance company. Now, it doesn't make much, it's the same strategy when we talk about reverse mortgages. So in a reverse mortgage, you can choose to use single life or joint life. Now, I'll put a little disclaimer in here. There are so many different reverse mortgage banks and programs. Now, while they're all monitored and managed by the FHA, I'm not telling you that the bank that you go to will allow this if you're married. Sometimes they will, and you have to have a spousal sign-off. But as an example, let's say I went to a reverse mortgage company, and that reverse mortgage company tells me that if I'm married, let's say that we're both 65 years old, and let's say I have a $500,000 house. Let's say they tell me that if I do joint, they're going to give me 50% of my value of my house in a reverse mortgage jointly. But if it's a single, let's say they give me 65%. So the calculation is for that difference of the 15%, can I go buy life insurance and possibly even get the long-term care coverage on it, which I wouldn't have had before. And if I die first, then my spouse has to pay off the reverse mortgage, because remember, the reverse mortgage is just my name. But if she's got the life insurance to do it, she can pay off the reverse mortgage, and then my spouse can go redo the reverse mortgage and get a higher amount probably by that time if the house is appreciated. Or can I not buy the life insurance? You might have a health issue, a chronic issue. You can't buy life insurance, or the life insurance is too expensive. So your only option is the joint. But again, that's why you have a qualified fiduciary financial planner to run and calculate those numbers for you. So again, let's review these actions again. And we got one more: to use life insurance to pay for the Secure Act change. So many of you know we are working diligently, and there has been so many changes now with all of the bailout, the $1 trillion of bailout. We've been working on deciphering all of that. In addition, in January, the Congress approved the Secure Act, and the IRS just a few weeks ago released all the final regulations on the Secure Act. And as you know, because you've been probably listening to me, that if you pass away and you have an IRA, your children are no longer eligible to stretch that IRA out. So we've come up with a couple solutions and options. One is the asset protection, which we're working on now on having to revise the revocable living trust and having to revise the standalone trust, which we don't have the option because of what Congress did. The other is, do we convert it over time into a Roth? Do we convert it now or over time into a charitable remainder trust? But if those are not viable options, we then compare it to, what if we just bought life insurance? What if we used an inexpensive, commission-free life insurance policy? And what happens is we don't have those options, the Roth or the CRT. But what happens if we just said, hey, what we're going to do is we're going to pay for some inexpensive life insurance so that when the client passes away, the life insurance will pay the tax on the IRA. This is what we call discounted dollars. Let me explain it. If you attended my 1929 crash strategies, I talked about the utility companies. I talked about your cable companies. I talked about trying to negotiate some discounts during this crisis. This is no different. If I go to my utility company and I say, listen, I owe you $300 this month. And if they said we would take $50 or $100, I would jump on that in a second. It's not much different than an IRA using life insurance to pay the tax. Again, you got to do it correctly, meaning you got to use life insurance that is inexpensive enough so that it is much less cost to pay for the life insurance than it would ever be to pay the tax. If the tax was $3, but you could compute over life that the life insurance would only be $1 to even a maximum of $1.50, I would do that all day long because I want to pay as little as I can for tax and insurance. Okay, so these again are all just calculations that we make in our office. I know a lot of people that are listening today, insurance agents have tried to convince you that these life insurance policies are these great retirement vehicles. Here's what I would suggest you do. Bring in what the proposals are. We'll run the calculations for you, and we'll tell you whether this is a viable option or not. And we'll also tell you what things that you might need to look for. Well, with that in mind, I'm going to open it up to some questions before we wrap up today. And I see a couple questions coming in here. Let me just jump on real quick here. Keep the questions coming. I'll sift through them. I'll be able to probably answer a few at the time. Let me just real quickly answer for you. I cannot say I'm looking at some questions here. There's some things here I can't answer for you, like specifics. Like here's the one question, in these times, should I buy more life insurance? That's a calculation. I can tell you in this kind of medium or communication forum how we think from the top down and what needs to be done. But I can't answer for you, should you be more in the market? Should you be more in stocks or bonds? Should you buy rental properties? Should you, like this question right here is, should I get rid of my life insurance? I can't answer those. If you have other questions that pertain to generalities, let me see what I've got on my question list here. Okay, so here's a good one. What happens if I add more to my life insurance now so you must have a variable life. Okay, so I'm not sure if you joined a little bit late. I would highly try to convince you not to keep a variable life. Now, I'm not telling you that right now is a great time to get out of the variable life, but I'm telling you that I am not a big believer in these in any way, shape, or form. I would have some calculations done to see if these make sense to even keep those. So I don't know if I should answer that or not, because again, I don't know the policy. Beneficiaries, here's a good one. So on my life insurance policy, I have my kids named as the beneficiaries. Well, again, going back to not a good idea, in my opinion. Don't ever name humans, because what happens if you die on Monday and on Tuesday your child gets it and they die, they get divorced, they have a disability, or they get in a lawsuit? They may never get that money. Or here's another case. You could leave it to one of your children and they pass away, or they give it to the grandchild because of their inability to accept it, and your grandchild's 18 years old. Now, if we haven't learned anything, the thing we don't do is ever leave a large lump sum of money to a young person. Years ago, I would have probably said, well, if they were mature. I have this very strong belief that unless you earn it, then you are going to have a hard time understanding how to manage it. If you have earned it, you have paid sweat and blood to earn that money. You have a different respect level. I have yet to see, and I've settled many estates over the years, I've seen very few kids and grandkids at young ages like 18 and 19 that either A, understand it, B, appreciate it, C, know how to manage it. So that's not a good idea. Okay, so I'm seeing some more questions come in here. Here's what I'm going to do for those of you that last time, if you've attended these webinars in the past, you know that what I want to do is make sure that I'm answering as many general questions. Those of you that have sent those questions in that are more specific, I'll send you emails. When you signed up, if you used your right email address, we'll send out as many of those answers that I can. And with that in mind, before I wrap it up, I just want to go through one more thing here. Let me just find my spot. Bear with me. Here we go. Okay, let me pull this into view. And for those of you that want to know when we're doing live casts, you can just log on to, you'll see it on your screen in just a second, onto YouTube, and YouTube allows you to subscribe. So if you want to just Google H&H Retirement on YouTube, you can use any browser to query or question that. It'll take you to the YouTube, and on the right-hand side, just hit the subscribe button, and it will allow you to subscribe. You'll see it in just a second. And then you'll be notified of any of the live casts that we do. And you can see here some other live casts that we did that you can actually just go on there. If you want to watch them again, you can watch them again there. Also, we've just added live casting to our actual website. So what you can do is just log on to our website, which is hhrdm.com. And let me just go to the website so you can actually see it. And that's the live broadcast. And once you log on to hhrdm.com, just come on over here to the right. If you want to get a listing of all the events, just click on events, and you can see the upcoming broadcast schedule. We're working on the continuation of our broadcast schedule. But if you want to log on to the broadcast, you can also just click on live broadcast. And while we're not streaming right now, it will, once we start live streaming, allow you just to go right to our web page and go from there. Okay. I'm going to wrap it up now, and looks like I still have some questions coming in, but I will answer those for you. Okay? Before I go, I just got to do this one more time. Come on. Get a vote for this, right? Hey, listen, if you want one of those face masks, I see a lot of people raising their hands. Listen, if you want one of those face masks, send your planner just send them an email and just say, hey, I'd like one of those. We're going to do the best that we can as far as getting the fabrics and, Joyce getting them out and getting them out to you. But hopefully we can have something that's a little bit more fashionable than what we picked up at Walgreens. With that in mind, have a great night.